Alrighty, guys. This week we're going to go over chapter 10, which is purchases and cash payments. Now, one thing about the purchases is that that's the account that records the merchandise, okay, that we buy for reseller, like Walmart. It purchases things from other people, and then what they do is they go ahead and do a resale. Okay, it has a debit balance because of the fact that um, it is a cost, but it's also merchandise, which is inventory, which is an asset. Okay, it does represent all the costs that are directly related to bringing merchandise into the store and then selling it back to the customers. So this is what it would be like, or what it would seem like. Okay, so here we have purchases, costs, debit going up. So let's say that we purchase $4,000 to from Mattel. Okay, so we go ahead and debit the purchases, and notice we're going to go ahead and put it to the account payable as a liability to Mattel. So this is what it shows. Now, when we go ahead and pay Mattel out, and remember, the reason that we've got both of them here is because, remember, last week we are going over not only the controlling account, but also the individual account, okay? When we pay them out, of course, we're going to go ahead and make sure that we debit these two and credit cash. But again, this is why you see both of them, is because we are ensuring that we have both the controlling account and the subsidiary account for our accounts receivable ledger, okay? So then we have the returns and allowances. He noticed what happened. He received several defective dollars from Mattel and issued a credit memorandum for $500 reduction from the invoice. This is Chow, whichever way you want to say it. He bought them. He bought the $4,000 worth of merchandise, $500 of them being dolls. And what ends up happening is he found out that they're defective. So what he wants Mattel to give him credit, which would go ahead and decrease his amount. So now, as we had a sales and discount and return allowances, now we're going to have purchase allowances, because we, now the vendor, need to decrease the amount of inventory plus the amount of money that we owe these people, because we're sending the stuff back. So again, this is what you would do. You would debit your accounts payable, both for Mattel and for the controlling account, and then credit your purchase and allowances, showing that you've got a decrease in the amount of money that you're going to owe Mattel, which is only $3,500 now, okay? But this is going to be a contra cost allowance from the items that you're purchasing, okay? The other was a contra sales. This is a contra cost, okay? So we have returns and allowances, so this is what we did. We, again, debit the accounts payable and credit, okay? When there is a purchasing discount, just like if there's a sales discount, if we purchase from something, okay, and let's say that we're purchasing, and now we're on the opposite side, we're purchasing the items, and if we pay in 10 days, they're giving us a 2% cash discount. So how we take it off of our books is we go ahead and we still, okay, we still show that we're going to debit our accounts payable by $3,500, the entire amount, okay? Because we're paying, they're giving us a discount. So what you're going to do then is 2% off of the $3,500 that we owe is going to be $70. So all we're going to credit cash for is going to be $3,430 instead of the $3,500. Again, what we're doing here is we're showing on the opposite side, instead of it being sales, we're now on the purchasing side. We're showing how a vendor goes ahead and does the same thing, except that it's not a sales discount and it's not a sale allowance. Now it is with returns. Now it is the vendor, the one purchasing the stuff, and the reseller saying, no, this stuff is not working for me. This is not working right. I'm going to send this back. Or yes, I now have the money to pay back the amount of money. I want to take advantage of your 2% discount that you're giving me. That's what we're showing here. Remember, a retailer selling to customers, but the retailer is also a customer of a vendor that he's purchasing from. Okay? I know sometimes it's kind of difficult, but really it's not. So we have the purchase discount, and this is how it shows it, that we pay out the $3,500. So we debit the accounts payable, and the controlling account as well, and we go ahead and we purchase, we credit the sales discount, purchases discount, and we credit cash because we're actually going to go ahead and pay them ahead of time. Now, after the journal entry is posted and recorded, the result will show that Child saved $70 because that's what he did. He saved the $70 for 2%. The actual or net cost then of his purchase is this. Okay? He started with $4,000, but he returned $500. Then he went ahead and got a 2% discount. So his net purchase actually is not the $4,000. It's actually just the $3,430 that he paid out. Okay? Net purchase. After all the discounts, after everything, that's how much he paid out. Okay? We also have freight. Freight, we have two. Freight on board or freight to the shipping point. Okay? That's when the buyer pays for the shipping charges. Like when we buy from from Amazon. We pay for the freight. Now that becomes legal title now passes to me because I've already paid for the items that I'm purchasing from Amazon. Okay, so that means it now belongs to me. If it doesn't come in, then I get a hold of Amazon to say, hey, where's my stuff? What happened to my stuff? Okay. Now, there's no discounts that are taken on freight. The discounts are done before because, again, the vendor has made arrangements with either DHL, UPS, or FedEx for a set amount of money to say this is how much everything's going to cost when we send out. Okay? And notice they're always telling you, well, if you buy so much money worth of items, then guess what? Shipping is free. That's because it's already paid in. It's a discount for you, but it's not the shipper giving you the discount. It's the vendor because they've already paid out to the shipper. Okay? I know that's a little convoluted, but don't worry. We'll go through it and make sure that we understand it. Freight destination means that the seller is paying for the shipping. So if anything happens, then the seller has to take care of it. When the seller pays for the shipping charges, then legal title doesn't become ours until we pay or it gets to the destination. All right? So that's the differences. So when we're posting the purchases and transactions, this is what we've got to do, make sure that we're doing. There's a purchase requisition. One copy or a PO, okay? A purchase requisition goes to purchasing, copy goes to accounting, and a copy is in the department making the request. That way, okay, purchasing realizes that we're getting this in, or central receiving, so we should be getting those items in. Accounting knows that when we get it, purchasing will let accounting know, and then we pay. We make sure that we pay out. The department has to keep a copy as well, so that if something happens, the department is the one that actually keeping most track of it, saying, hey, where's my goods? What happened here? Was it paid out? Has it been done? What's going on? Okay? When we're posting purchases and transaction, we're taking this information from a purchase order or a PO, and we're actually looking at this and we're saying that from Art's Wholesale, okay, Art is the one selling, Abby Blake purchased from him, or we purchased from them. And we purchased from them 100 lady jackets at $50 a piece for $50,000. Okay? So Art's Wholesale by Bill Joy. Bill Joy is the one making this purchase order and making sure that everything is okay. Purchase order number 1, 3,000, whatever the case may be, there's always an order to them. It's usually sequential. And the reason why also it changes up every year also to make sure that for every year that these are the purchase orders that were done, because you have to close out the year, closing out the purchase orders, what came in, what didn't come in, what was canceled, the whole 9 yards. Because again, remember, accounting is the analysis of what happens not only on a daily basis, weekly, monthly, quarterly, and then finally at the end of the year. So when we're recording and posting this, this is the invoice that's prepared by the seller. Okay? So we get this invoice. We also have to deal with freight. Okay? So when we get it, or being Art, because we're getting it from Abby Blake, okay? We receive the goods and complete the reports. And of course, the receiving report verifies that the merchandise was received in good condition. If not, this is the first point that they review it to see if everything's okay. The department also is supposed to review, and the ending department, finally, when it finally gets to the area, that everything is okay. The company doesn't record the purchase until the invoice or everything that's coming in is recorded and then payment is made. So one of the things that we have to make sure that is done, some people have another kind of invoice. The invoice to what we purchased usually has the purchase order number, the check that was written out finally to pay him, the order check, the receiving check, who did it, the invoice check, and then approved for payment. Who is the one that's actually doing it before we, and this is just a check, and then the approved for payment, then after payment, then also what the actual number of the check was or the electronic transfer was to ensure that this all got paid. So the introduction to the subsidiary ledgers and a debit memorandum, these are some of the things that are going to be going through, that we're going to be going through right now. Where on the 3rd, we purchased merchandise on account, the freight, the terms, okay, purchased equipment on account for $4,000, purchased more merchandise from Thorpe Sullivan. So all of these are going to be in your what? Since we're the buyer, it's not going to be in accounts payable, not in accounts receivable. Okay? So, and then any items that were returned or any kind of that were returned because of defectiveness. Okay? So the accounts affected, of course, are going to be purchases, freight in, accounts payable, of course, and then any discounts. So here we have the first one, purchases for $5,000 on April 3rd. Here we go, right here. We purchased that amount of money, freight in, that's an account, how much it cost, okay? Then accounts payable to Abby Blake Company, because we owe them for everything, not just freight, but also the purchase. In accounts payable, we owe them the entire $5,550. Purchase made on account from Abby Blake, okay? Simple, easy. Then we have to go ahead and make sure that we put it into the subsidiary level ledgers for accounts payable as well, okay? Just the way we did in accounts receivable, now we're doing it in accounts payable, okay? Don't let me get you confused on that, because we're working with accounts payable. But just like last week, when we had the accounts receivable ledgers, where we were having the controlling accounts and then the subsidiary accounts, same thing is happening right now with the accounts payable, because we're the ones purchasing, okay? So notice what we have here. Again, accounts payable, not accounts receivable. Accounts payable, the people we owe, which is Abby Lake, Joe Francis, John Sullivan, and the Thorpe Company. Okay? This is what it would look like. Basically the same as the AR, accounts receivable. But now the different accounts that we're going to be using, instead of sales, returns and allowances, it's going to be purchases, returns and allowances, freight, because we're getting charged for freight, purchases, if we have any equipment or supplies, and then of course your controlling account of accounts payable, and then your subsidiary accounts for account payable as well. Okay? So here we go. So here, this is what this would look like with the individual account numbers. Remember, we place a check here to show that not only have we placed it in the controlling account, but also into the subsidiary account. That's all we're doing there. When we have a debit memorandum, this is issued by the customer to the seller saying, guess what? I'm returning these to you. I want you to give me credit for these items that were defective. But we have to let them know what was defective, how it was defective. So it's called the debit memorandum. Okay? Don't be confused. It's debit memorandum. All right? So what we do then is we go ahead and we journalize it by saying this. Accounts payable from the Thorpe Company. The reason that this is torn up that way is because now this is April 9th. Other things have gone on before the 9th. We're just showing now what's happening here with the Thorpe Company. So we show where we're asking for a debit to accounts payable and a credit to the returns and allowances based off of debit memo number 1, decreasing the amount of money that we owe the Thorpe Company, and then having to show how much we have, where that money went with purchases and allowances to say, okay, yes, this is something that we had defective rims, we returned them, and showing that they're not in our inventory anymore. We don't have them here. We ship them back. Okay? So when we debit that, here we go. We had from Abby, right? Then we're showing our controlling account. Here we're showing the Thorpe Company. On the 6th, the one that we just did, on the 6th we show where we purchased it, but now on the 9th we're showing where this is decreased. So now we only owe them $600. Okay? This is our running balance as well, as to how much money we've been crediting or debiting, so we can have our balance with the controlling account. Again, the other things that we purchased throughout the time, but just showing how we posted the debit memo. Okay? Now we're going to go ahead and get into our cash payments.